Welcome to Author's Note. One market in the spotlight this year is the multi-billion-dollar infrastructure debt market, which some investors argue is now at a turning point, as many banks are no longer prepared to offer loans for big building projects. Ed Hammond, the FT's property correspondent, is in the studio to discuss the implications of this trend and what it might mean for governments and the market. Our first chart shows that project finance spending has fallen sharply in 2012. In fact, has fallen sharply since the peak in 2007. Ed, what is this chart really telling us?
What you're seeing here is actually the banks that typically were the main source of debt finance for this market have gradually pulled out. Obviously, they came back slightly in 10 and 11 as there was a bit more confidence. I think the Eurozone crisis sucked that confidence back away from the market. So you're seeing really a long-term trend, which is the banks coming out of the market. The reason this is happening is because there is a lot of risk for them up front in project finance. Obviously, the capital outlay at the point where they go into the project is very large. They might not see returns for 5 years, sometimes even longer, depending on the scale of the project. The one hope, though, is that you're going to see the emergence of a new source of finance, or newer, perhaps, sources of finance for this market, which would include things like the big asset managers, some of the life funds, perhaps even sovereign wealth funds, and maybe some specialist providers as well.
And are we seeing this happening now, do you think?
We're beginning to see it happen. I think as this trend is happening across all fixed assets at the moment. So we're seeing them come into some commercial property, we're seeing it into infrastructure, we're seeing it into all sorts of fixed assets all over the world. But it's important to say it's a tiny fraction of the money represented by the banks.
And what kind of projects do investors prefer? Is there a difference between so-called social projects like schools and hospitals or other projects? What are your thoughts on that?
Well, as with all long-term investors, they tend to favour safer projects. Safer projects typically are ones where the tenant or the covenant is very strong. Therefore, it would normally be a government-backed project like a hospital, like a school. Now, the way that they're funded is that the person who delivers them, or the company that delivers it, gets their payment essentially for making the asset available. So it's availability driven. So if it's a hospital, all you need to do is produce a hospital. The payment is not reflective on how much the hospital is used. If it's economic infrastructure, something like an airport or maybe like a toll road, then it's different, because then there is a risk, because then it's tied to the economic cycle. If you don't have passengers going through that asset, then actually you don't make any money on it at all. You don't make as much money as you predict. So the tendency is to go towards the safer social infrastructure assets that are availability driven.
And our second chart looks at the difference between infrastructure debt yields and the so-called risk-free rate, which government bonds trade at. Clearly, there's quite a big yield pickup, or 3 percentage points in fact. Should that in theory bring investors into the market if they can obviously get better returns from infrastructure?
It should, and perhaps not even in theory, it is bringing investors into the market. I mean, we're seeing this increasingly with the pension funds and the insurance funds in particular, but also increasingly with the sovereign wealth money. The yields just aren't there in the bond markets, either on the government side or on the corporate side. One way of looking at this is if they're getting this sort of yield down here in the government bond market, and they say, well, we're going to do a hospital. Well, then in a way, the covenant is exactly the same, because if the government defaults on its payments for the hospital, the chances are it's going to be defaulting on its bond payments elsewhere. So really, you're taking a very similar risk for a much, much higher return. And that's the way that they'll assess it. So they'll say, if we have a building, for instance, if you did it on a property and you said the tenant is the government, they're in there on a 20-year lease, well, then you have a 20-year guaranteed income stream with the government as the covenant. So in a way, your risk profile is identical to buying government bonds, but your returns, as you say, there's about a 300 basis point spread.
In short, then, we should see investors come into this market and this market expand.
I think that's right. I think whether or not they'll come in to the same extent that the banks are going out is a different question, and one that will take a long time to play out.
Thanks very much, Ed. In short, the infrastructure debt market should grow quickly as investors seek higher yields than government bonds. However, with all the uncertainty out there, you can never be sure how fast and how strongly a market can grow.